Why is the setting of this overnight interest rate so important to a government?
Well, I mean, it's a statement of monetary policy. And I'm sure both Randy and I think that it's less important than the conduct of fiscal policy. But this ideological shift that I talked about previously, it started around the mid-70s and really gathered place in the 80s when they first of all tried monetary targeting, because this was the period of monetarism, and where they were influenced by the writings of Milton Friedman and Fisher and others earlier. And they believed there was an intrinsic one-on-one relationship between the supply of money and the price level. And if you wanted to control the price level, then you needed to control the stock of money. That's what their belief was. And this was called in the literature the quantity theory of money that came from the classical era. And so the first wave of neoliberalism, which was known then as monetarism, and this is Thatcher era.
And Volcker in the US.
Paul Volcker. And here we suffered the same indignity. They tried a system called monetary targeting. They would set monetary targets, and they would say if inflation's going to be, you want inflation to be 3% and you want GDP growth to be 3%, then monetary growth has to be 6%. That's what they believed. The sum of the two. And that failed dramatically, because they soon learned that the central bank couldn't do that. And they replaced that system then. Remember, we were still in the wash-up of high inflation after the OPEC supply price hikes in the 70s. And so that monetary targeting morphed into what we now know as inflation targeting. And they realised that really all they could, in a fiat currency system, all they could really do, and they can certainly do it, is set the short-term interest rate. The interest rate which regulates the overnight, the interbank sort of market, the overnight borrowing and lending between what are called member banks. And with the growth of neoliberalism and the fundamental distaste for fiscal policy that emerged out of that, monetary policy became the prime aggregate weapon, and it shifted its target in very sketchy ways. Very confused at the beginning. In Australia, there was a lot of debate in the late 80s as to whether they were targeting an exchange rate or a price level, if you remember back then. And that, monetary policy was inconsistent in those days. But eventually they worked it out, and by the 90s they worked out that they were only going to, their sole role was to maintain low inflation, because there was a lot of new growth theory that was coming out from the neo-Keynesians and others who tell you that all you had to really do was get price stability, get inflation down, and the rest of the economy would rip and you'd be fine. And so the monetary policy target became the key expression of the role of government. And note I use the word government because while we want to pretend the central bank is independent of the Treasury and the elected government, it's not. And from an accounting sense, it definitely isn't, because it's all part of a consolidated government interaction with the non-government sector. But yeah, by the 90s that was their sole expression, and fiscal policy became very passive, because if there was a widespread belief that fiscal policy was essentially futile because it might work for a little while, but it would ultimately cause inflation. And the inflation of the 70s was there was a revisionist history that was all to do with indiscriminate fiscal policy use. And so by the 90s and into now, we've had this emphasis on monetary policy. Fiscal policy had to be passive because it couldn't exacerbate monetary policy. and that's why we've got this emphasis on the cash rate. But as far as, you can ask this question if you like, I would have the cash rate just set at 0 and leave it.